Picture a woman with a 680 credit score. Good credit, the kind that gets you approved for a car loan, a decent mortgage rate, a new credit card without a second glance. Then almost overnight, that score drops to 580. Not because she missed rent or maxed out a card or made some reckless purchase. Because of a student loan payment she thought didn't matter anymore. It mattered, and she is not alone. She is one of millions. Here's what actually happened. In March of 2020, the federal government froze student loan payments and, just as importantly, froze the credit damage that comes with missing them. For years, that pause meant a missed payment was invisible. It didn't hurt you. That pause technically lapsed in September of 23, but the Biden administration layered on a 12-month on-ramp, a grace period that kept delinquencies off credit reports even longer. That on-ramp ended September 30th, 2024. Then, on May 5th, 2025, the Department of Education resumed full collections on defaulted federal loans for the first time in 5 years. 5 years of borrowers assuming, reasonably, that the rules had permanently changed. They hadn't. The scale here is enormous. More than 42 million Americans owe federal student loans. Roughly 5 million of them are already in default. Add in everyone who's fallen seriously behind 90 or more days past due, and you're looking at about 6 million borrowers, representing 13.7% of all outstanding balances. TransUnion's own tracking found 5.8 million federal borrowers reported as 90-plus days delinquent, with official default status kicking in at 270 days past due. And this isn't spread evenly. In Mississippi, 44.6% of student debt is 90-plus days past due or in default. In Illinois, it's just 13.7%. Same country, same broken pause, wildly different fallout depending on where you live. Now, here's the part that should genuinely surprise you. This isn't just happening to people who already had shaky credit. Nearly 44% of newly delinquent borrowers had credit scores above 620 before they missed a payment. Scores solid enough to qualify for a mortgage, an auto loan, a real credit card. About 2.4 million of them fell into delinquency this year, with credit that, weeks earlier, looked completely healthy. And the higher your score, the harder you get hit. Borrowers in the 620 to 719 range saw their scores fall by an average of 140 points. Borrowers above 720, the best credit in the country, fell by an average of 177 points. The safest-looking borrowers took the biggest hit because they had the furthest to fall. It's a big enough shock that the national average FICO score actually dropped to 713 in 2025, the first annual decline nationwide since 2013. Meanwhile, baby boomers, who mostly finished paying off their own loans decades ago, saw their scores rise. This wave is hitting one generation almost exclusively. And there are two things almost everyone gets wrong about what happens next. First, people assume the COVID-era missed payments simply don't count, that there's some kind of amnesty baked in. There isn't. Once a default or serious delinquency reports, it can sit on a credit report for 7 years, even if the borrower later gets current again. Curing the debt doesn't erase the history. Second, people think all defaults are permanent, full stop. That's not quite true either. The Department of Education's Fresh Start program, which let borrowers exit default and have that default deleted from their credit report, was real, and it worked. But it ended in April of 2024. Anyone who didn't take advantage of it before the deadline is now facing the full 7-year mark, even though notably some Fresh Start participants still owe the underlying loan. The default disappeared from their credit file. The debt did not. So what does a 100 or 150-point credit score drop actually cost someone in real life? Researchers estimate that kind of credit destruction can add up to $64,000 in extra interest over the life of a mortgage, and roughly $8,800 more on an auto loan just from qualifying for worse rates. That's not a rounding error. That's a used car versus a slightly better used car. That's the difference between owning a home in your 30s or your 40s. Added up, and government estimates suggest nearly 9 million borrowers, about 1 in 5, are now in default or on a path toward it, the largest population of defaulted student loan borrowers on record. many of them now at risk of wage garnishment down the line. This isn't a story about irresponsible college kids. Most of these borrowers graduated years ago. They have bonds, mortgages, car payments, kids in school themselves. The loans just went quiet for 5 years, and quiet doesn't mean gone. Quick note, nothing here is financial advice, just an explanation of what's happening and why. Talk to a qualified advisor about your own situation. If you want to understand how debt actually gets collected once you're in default and what borrowers can still do about it, that's exactly where the next episode of Debt Reckoning picks up. Because the credit score drop is only step one.